Welcome to this week's Q&A. I've had a question this week from a viewer in Sydney in Australia, and he's currently on a fixed rate loan at 1.89%, which is going to expire in June of next year. And his question is, what do you think rates will be when my fixed rate loan expires? We're getting so many questions, obviously, in relation to interest rates these days. However, it's important to note that when these fixed rate loans, and there are quite a number that are expiring around this time in 2023, when they roll off, clearly there's going to be a massive increase between the rate that people are on, which was generally around 1.89%, and the prevailing rate then, which will be more likely somewhere in the fives, potentially in the high fives, and the range of fixed rate loans available then is really too difficult to assess right at this stage, because that was the second part of this person's question. So what we have to look at is what's happening, and currently my belief is that we will probably see another 50 basis point increase to the OCR in October when the RBA meets, and then potentially two further moves of 25 basis points going into the end of the year, which would end up with an official cash rate set by the RBA of, say, 3.35%. And that means that obviously variable rate loans will be somewhere between 5 and 6% after receiving the major bank discounts that you can, depending on the strength of the borrower. The interesting thing that's coming through now, though, is that banks are prepared to give higher discounts for people who have a lower loan to value ratio, lower LVR, so say below 70% and below 60%. So they're things to bear in mind. The other thing, of course, that's more structural and I think is really important is that obviously banks don't want to force customers into a situation of experiencing mortgage stress or financial hardship. So I'm reasonably confident that the banks will continue to try and develop products to assist existing clients when these fixed rate loans roll off. We recently saw Westpac and Commonwealth Bank introduce a 2-year fixed rate for home loans, which was below 5%, so 4.96%. So these sorts of measures, I think, will continue to evolve as we go through the further, the ensuing 9 months, to assist a lot of clients with this transition, so that financial stability remains, I suppose. So the answer to this person's question is, it's too hard to tell what the actual rate will be when the fixed rate loan expires, but suffice to say, it will be a lot higher than the current rate that they're paying. And it's something also to get some experience from, I suppose, that if you can fix your interest rates at a very attractive price, which we've been able to do over the last couple of years, then taking a longer term really made a lot of sense. If you found this of interest, please subscribe to our YouTube channel and click like. If you want someone to get in touch with you in relation to your own particular situation, just email us or call and we'll have somebody contact you. And I'll see you at next week's Q&A. I'm Andrew Unterweger.